Welcome, everyone. I think we have a good group of participants already in the webinar, so we're going to get started. Thank you all for coming to Invest, a series on impact investing. Tonight, we'll be talking about investing in low carbon strategies with our amazing panelists. They're hailing today from South Florida. We have actually a big South Florida contingency, Luis, David, and I. Allison is in Maryland, and Julia is hailing from Bogota, Colombia. Our guests are attending from all over the world. We have people from US, Latam, and Europe, so thank you so much for coming and joining us here. I am Julia Wilkinson. I'm the founder and CEO of Invest, and we capacity build investors, high net worth individuals, foundations, and funds on how to integrate impact and ESG into their strategies. We also accelerate high impact startups in the region, particularly Miami, Latam. So thank you again for joining us for this discussion. My background is in finance. I have 13 years of experience in capital markets, both in private wealth, venture capital, and private equity. And I have a special focus on emerging and US markets. So all of my events tend to have a bit of a Latam US expression. So our goal tonight is to educate, capacity build, and inspire you to invest sustainably and with impact. To do so, we're leveraging the relevant theme of low carbon investing, which has been very much on top of mind this year. Our guests tonight are going to discuss a little bit about their strategies towards low carbon future, their return profile, industry outlook, and share from their vast experience as professionals in the space. They'll be demystifying many of the risks and opportunities around this space. They're all representing private market strategies in both debt and equity, and we'll be discussing market rate driven opportunities there. So after you hear our speakers, we'll open it up for questions. In the meantime, you can feel free to chat in the chat on the side here, which should be open to the participants. And you can also ask any burning questions on here if there's anything you need to ask. So before I offer a quick refresh on what is impact investing and why it matters, we will take another quick poll on what is impact to you. I'm sorry, let me just quickly share results of poll 1. So by the way, as you can see here in the group, we have impact investors, family offices, advisors, and several students of life. So thank you so much for joining. Our next poll will be focused on, sorry if I can, what it is that impact means to you. So while I describe impact, these are some of the responses I've gotten in the past at different events. However, they're not conclusive. Impact investing is defined as intentionally investing for a financial return as well as a measurable social or environmental return. So again, financial and measurable, all with intentionality towards a goal. You can target market rate returns and be an impact investor. You can target concessionary returns. You can do this in public and private markets, all towards intentional goals. Why did this come about is so important? Due to the financial crisis, growing inequality, and climate change, environmental social governance and impact investing has taken off. Its goal is to price externalities and risks associated with environmental social impacts, as well as align capital markets with important big picture goals for society. So data repeatedly actually backs up and points to impact aligned strategies as reducing risk and volatility and potentially outperforming the market. So real quickly, let's review our poll here. So 41% of you say impact is the future. Obviously our panelists and I agree. Progress, opportunity, alignment, alignment got a lot of responses as well, and all of the above. So nobody put more risk. Very excited to see that. Thank you so much for your participation. So back to the theme of climate action and impact. Climate was already the theme of 2020, in part due to the year starting with the horrific fires in Australia, which now seems like a decade ago. Now we have fires in California. In between, we've had an unwelcome surprise, COVID-19. And what did COVID-19 remind us of? Like the financial crisis, that exogenous shocks can have tremendous global effects on our economy. And that may have resonated with investors who have been warned that COVID-19 is a blip in the economic history compared to climate change's potential destructive qualities. The result, a greater momentum towards investments in the space. Just this week in the public markets, Google issued a $5.75 billion impact sustainability bond. So JP Morgan issued a $1 billion one as well. And we're also seeing a lot of financial institutions either beginning to price in externalities around risks or report towards outcomes as well. So our goal tonight is to show you that it is possible to both reduce risk in your portfolio around environmental exposure and intentionally tackle all of the major causes of GHG emissions in a diversified manner across managers, regions, asset classes, industries. Again, what is the purpose? To intentionally arrive at the goal of a livable future in 2030, where we have reduced emissions by 50 to 70%, which is what scientists say we need to do to avoid catastrophic impact to both the economy and society. So does that seem like a wise thing to think about when you're investing long-term? To me, it definitely does. So let's get started on learning how to build a clean and tangible future with these guests who are already doing it today. So we'll start with introductions of each one of our panelists. Tell us a little bit about what you do, the key themes you're focused on, and where applicable AUM or asset classes you're using to do so. Plus one word that impact means to you. Allison, let's start with you. And you're on mute, by the way. Thanks.
Okay. Well, I'll answer the last question first so I don't forget. So Allison Shapiro with Closed Loop Partners. I'll explain what we do and what I do in a second. I think impact for us is observable net positive impact. So it's not a negative risk screen for us. It's an actual measurable impact. So for each of our investments, we're actually looking at material types that we divert from landfills and emissions avoided for every of our nearly 50 investments. So maybe I'll tell you briefly about my firm, Closed Loop Partners. We were started in 2014. We are a New York City-based circular economy investment firm, investing predominantly in North America, though we do have a handful of investments outside of North America. We invest across debt and equity strategies, venture, private debt, private equity. We have 6 investment funds. And we also have an innovation center, which is called the Center for Circular Economy, where we coordinate large industry projects to bring design solutions to market that intelligently consider material type and end of life in their very conception. And we are both concessionary and market rate. Excuse me, our 2 debt funds are concessionary, our 4 equity funds are market rate. So we have 2 early stage venture, 1 growth equity, 1 private equity.
Amazing. Thank you, Allison. How about David? Can you go next, please?
Sure. Thank you, Julia. So my name is David Fernandez. I'm a managing director at Goldman Sachs Renewable Power Group. All I've done, basically my entire career is clean energy, and out of this group, we only invest in clean energy. So our strategy is pretty simple. We have an investment vehicle to deploy capital in this solar market in the US, more focused in the middle market. So far, we have deployed about 50% of the capital. That equals to around 2 gigawatts of solar assets and a number of projects, around 850 across the US. I'm not, if we're not the largest distributed generation portfolio in the US, we're close to the largest. So very proud of that. And we target single high digit returns with long-term contracted revenues and very
David, can you speak a little bit louder? Apologies. Some of the guests are not being to hear you.
Apologies about that. So yeah, the vehicle that we have targets single high digit returns with long-term contracted revenues and very little merchant exposure.
Wonderful, thank you, David. Luis, can you introduce yourself, please?
Yes, thanks, Julia. Thanks, everyone. I'm honored to be here. My name is Luis Paul. I'm CEO of Otepi. It's an energy-related company. We own, develop, and operate assets in the energy industry. I also have spent all my career, 30 years in the energy sector. The first 15 were in the oil and gas, and the last 15 has been shifting to renewables. And I think I've been transitioning and seeing that this massive shift into renewables. I think I'm lucky about that. Our key focus areas are distributed energy resources to what we call the CNI sector, or David referred to middle market, battery storage and microgrids, and eMobility, and the integration of those resources. That's where we focus. We have two investment vehicles. One, it's Other Energy, which invests in solar and microgrid assets for CNI clients in Latin America, primarily in Panama. And that's an equity and project finance play. And then we have OBE Power, which is an equity startup company on the eMobility space. OBE is building a ecosystem of smart and distributed EV charging stations that, coupled with technology, we offer a charging as a service model, and eventually a virtual power plant for where people live, work, and play on the EV sector. The word for impact, I would choose exponential.
David, did you give us an impact word, or did I just miss it? Sorry. You're on mute.
I think Luis took my word. I forgot to say it, but definitely I'm really bullish about what is about to come. So definitely exponential will be also my word.
Awesome. Julia, you're next.
Thank you. So Julia Santander, I'm Managing Director of Investments at EcoEnterprises Fund. EcoEnterprises Fund is an impact investor with over 20 years experience in the sector. So we started out officially in 1998 as a sheer experiment of a handful of institutional investors and private investors interested in long-term sustainability, focusing on conservation goals, on environmental protection in Latin America. The fund at that time was really small, $5 million in investable capital. We have since then launched a Fund 2 and a Fund 3 now a year and a half ago, which have more than multiplied our initial investment capital. We are now managing a fund with just over $100 million in investable capital, which for us really is a great reflection of the trajectory of the overall sector, really, because we see that there is more interest in those sustainable sectors and the sustainable products coming out of those sectors, but also from the investor side, more interest to find those sustainable solutions in investment vehicles they can allocate their money to. Personally, we focus almost exclusively on Latin America, on the Andean region and Central America, most of all, wherever we see sort of a confluence of macroeconomic factors that benefit sort of our investment activity, as well as areas of great biodiversity and sort of rich natural resources that need protection and conservation. We work in everything that we call nature-based sectors. So we focus with a big share of our investments on sustainable agriculture, on agroforestry systems, forestry, but also on ecotourism. And over the past years, we've ventured more and more also into tangents, which could be, for example, ag tech or any other business models that support innovative businesses in the sectors where we started out. What we provide is mostly flexible long-term debt and mezzanine instruments tailored to the specific realities of the companies we work with, of the economies where we operate. And what we really try to do is to fill a gap in local capital markets, especially sort of building long-term partnerships with the companies we work with, because that really allows us to go beyond just putting in money into a business and sort of making a financial return, but really sort of work with the company across the three sort of axes that we want to see them build and strengthen, which is their financial performance, but also the social and the environmental impact that they're generating in the regions where they operate. So the impact word for me, I guess, would also be a mix on one side, balance, because we continuously balance a very diverse spectrum of interests. Of course, the financial interests of our investors, our financial interest as an investment fund, but also the interests and sort of long-term perspective of all the stakeholders that are involved, both the entrepreneurs, the teams, but also the communities where they operate. And the second word I would throw in there as well is push, because it's still sort of pushing, like I would say, friendly nudging our companies to sort of not lose sight of any of the three sort of focus areas that I just mentioned, but also really make a push to make that investment approach of ours more mainstream as we go along and really build the track record that encourages more people to take a look at this type of investments, because that is our experience as the fund has sort of replicated and launched another fund and another fund. And we've taken most of our investors along since day one, and really based on that sort of data that we could compile and show for to really sort of show that this is not just the vague experiment and idea it was back in 1998, but really sort of has come a long way and is now sort of a viable option for anyone, I would say.
Thank you. Amazing. Thank you all for coming. This is such an interesting panel. So now let's move on to the big picture of how each of you tackle GHG emissions, and then we'll move on to your investor profiles, et cetera. So we'll start with transportation. Transportation leads transportation and other factors. Transportation leads on CO2 emissions in the US with about 29% of total emissions. However, electricity, industry, commercial and residential real estate are runners up, largely in part because they depend on fossil fuels to power vehicles, to power construction, to extract resources, to run plants and businesses and heat up properties. So, David, what trends do you see since the fossil fuel industry is so responsible in some ways for the emissions? What do you see in terms of U.S. renewable trends that may be shifting the needle away from fossil fuels towards more renewable investments at scale? And speak a little bit louder because people are still having trouble hearing you. Sorry.
Sorry about that. Is this good now?
I think the mic.
Say that one more time, Luis.
The mic. Try to.
Yeah.
The mic. Hold on a second. I am still getting used to this.
It's sounding better. If you're closer to it, it's better.
What about? I cannot move the mic. But let me see. What about now?
Oh wow.
Yeah.
Yeah. Perfect.
Luis, like always, is fixing. Apologies for that. What I'm going to talk about, the trends is from kind of like the investor side. But let me say a few things about the renewable energy, as a kind of as a whole. In my mind, I don't think it's a question of of whether we're going to have renewable energy as part of the the energy generation mix or not. It's just about how fast the penetration gets in there. I think that we have passed the point where is renewable energy is going to be there or not. We can have all the roadblocks that they can put us in front of us, but the reality is that this is way too big of a market. It is been proven that it works, and not only works, but from the economic standpoint, we can compete with any other generation, conventional energy, energy or not. So it's just as a question of how big the penetration and how fast the penetration is going to be, and not a question of like whether we're going to have the renewable energy in our lives. A few things, and I commented this, a month ago in a podcast that I did. Few facts about solar that some people may not know. So solar has been the fastest renewable energy source, the fastest growing renewable energy source since 2017. And this year was well suitable to be for the first time to pass wind as far as installed capacity in a year on a worldwide basis. So definitely a lot of good positive things going for solar, and I just want to start with that. Our view, we're really focused into solar. And why is that? Because the investor base really likes the solar kind of investment, and the reason why that is that when I talk to investors, they like the fact that they're earning high yield returns while taking investment grade risk, especially in the middle market. Which I think is, the tendency and the trend that we've seen over the last, 4 to 5 years is tremendous growth in the mid-market and the C&I, community solar and things of that nature within the solar market. So just, if I want to just kind of maybe explain a little bit more on why we think that you're earning high yield returns while taking investment grade risk. So for example, let's put an example. Last time I checked, I believe that Amazon's that was trading about 2.5 for 40 years. So what about if instead of taking that, you sign a PPA with Amazon to put a system on top of a distribution center? You could get a return of let's call it 7 to 8%, so 500 basis points above what the debt is trading, with the same credit risk essentially. And if you think about it, actually it's a lower risk in my mind. If you have a solar asset, you actually have a secondary remedy in the case of bankruptcy. So you actually take in it's a less risky kind of approach than just buying the bond at 2.5. So that is why we say that you're taking the same credit risk but with an enhancement on the returns, and investors they love that. The other reason, tied to that, investors, they have kind of explained to us, and it was obvious to me, but once they put it up, kind of like in words, it was really impacted, or at least impacted me quite a bit, which is that it's a very safe investment within the renewable energy kind of mix. If you think about all the resources, wind or hydro, whatnot, they have more volatility than solar. Solar on a yearly basis, the volatility is not that much, so the cash flows are fairly secure. Also because they have very predictable operation and maintenance cost, and I'm sure that Luis will testify to that. But so at the end of the day, from the investor perspective, they're investing in a green attribute, in a green. They have a green portfolio in there with a very low volatility and a high yields. It's a no-brainer. And the last thing that I will say is that, and why the middle market instead of maybe utility scale. The reality is that the mid-market, what gives you is a very low risk of execution. It's a fast for those investors that they're taking some development and construction risk. They will see that this middle market gives them that low risk profile on the execution front, while maintaining the returns even higher than utility space.
Thank you. And also, just on that point, also I believe that fossil fuels, the cost of capital has gone higher than renewables, right? Are you seeing more interest shifting also due to that shift?
Yeah, I mean, certainly. Right now, if you know, we understand that, of course, the renewable energy is not a dispatchable energy if not paired with batteries. But you know, so you cannot compare. You know, it's not apples to apples. But the reality is that the cost to serve or the cost to generate for fossil fuels is really high. Where we see, you know, cost to operate these plants, you know, very low. And there was an analysis done by one of the consultant firms a while ago where they compare fossil fuels LCOE without the capex, so just the opex, and it was actually higher LCOE than solar and wind with capex and opex included. So basically, what it's saying is that it will be advantageous for those owners of, you know, fossil fuels, you know, plants to shut them down and just build on the same land, you know, solar or wind.
Very interesting. Thank you, David. Luis, you and David are longtime colleagues in the renewable space and have just had many discussions about renewables and distributed energy. We've also spoken a lot about the democratization and distribution of energy as it relates to e-mobility. Can you talk a little bit, with transportation being number one in CO2 emissions, can you talk a little bit about what trends you're seeing in e-mobility, distributed energy, and the relationship to the low carbon transition?
Okay, thank you. Yes, well, first of all, what is distributed energy resources? I guess this middle market, or CNI, is basically what we see is the combination of assets that can produce, manage, and store energy at the point of consumption. That's basically what distributed energy resources, commonly known as DER. This sector of the energy production, it is growing really fast, and according to Navigant, in 2017, investments in that sector were as high as investment in the centralized generation. So as deep as that, and it's supposed to be growing very fast, and that's why we like this sector for the coming future, especially going into 2030. The reason that this is happening, in my opinion, is because of three things mainly. One is that renewables and solar make it happen fast. And as David was saying, the technology risk has gone down dramatically. Second is digitalization of assets and the integration with the smart grids and energy sector that and coupled with legislation that allows that to happen. And the third thing is electrification of transportation. The electrification of transportation, it's the link to e-mobility. Basically what happens is that with the electrification of vehicles and cars and fleets, then those become assets that with those batteries will be able to be integrated on DERs in a way to produce and manage and optimize energy in a centralized, in a distributed location. So to give you an example, if you have this distribution center that David was saying, then you might be able to combine solar storage plus EV vehicles and make sure that that location becomes carbon neutral by producing electricity, managing it, and not only providing that to the specific center, but also to the fleet of vehicles and transportation fleet that they need to be used in that specific location. So this is a very, very good way to go carbon neutral, very fast for companies and at a local level. That's in essence how we see that.
Thank you, Luis. Allison, at Close Loop Partners, you guys are transforming the way industry envisions the cycle, let's say, of industry, both on the emission side and waste, to building a circular economy. So can you tell us a little bit about how you are challenging the way industries create, reuse, recycle, and repurpose towards circularity, and why that's important for emissions?
Yeah, so I'm going to take the last part of your question again first, like last time, because I think that frames why we exist. So if you think about the first big wave of renewable energy and climate-oriented investing in the 90s, a lot of it was focused on, and still is, cleaning the sources of electricity, cleaning the grid, the extraction, the generation, the distribution, et cetera. In the early 2000s, you started to see the advent of natural ecosystem-based sequestration projects. That's where I actually began my career almost 15 years ago. And then more recently, we're thinking more innovatively about sequestration and also more innovatively about how we've picked a lot of the low-hanging fruit in efficiency. We obviously need to expand renewable resources, but we need to also tackle the other, depending on your data source, 40 to 60% of emissions that come from how we build and how we consume products. And that you can think about that in a consumer basis, you can think about that in a B2B basis. But different studies will tell you it's somewhere in developed countries between 40 and 60% of emissions are related to how we build and how we consume products. This becomes more challenging when you don't have large buyers of material and you actually have to develop a mechanism for changing behavior on the household and individual level. And that's really where we play. So we look at emissions in our investment theses for impact. So every investment that we do, we'll do a BAU assessment, business as usual assessment of how much material is diverted from landfill, which is our first impact screen. So I want to be clear that we are not an emissions reductions first investor. We are a waste diversions first. But the second set of criteria that we do consider related to impact is emissions. And then in certain of our funds, we also look at social impact metrics, local economic growth metrics, and water reduction, so water intensity metrics. We invest along the life cycle of a product in 5 areas. So how it's produced, which is its materials, but also literally the how, the technology used, the distribution, the product consumption, the post-product collection, which those of us on the phone might think of as recycling. So are you driving it to a local bin? Is it being collected from your house? Is there any infrastructure related to help the consumer or the business actually collect the material? And then finally, the repurposing, the remanufacture, the reprocessing into something else. So for us, this is, as mentioned, this is really a waste diversion strategy first and foremost, and trying to extract the economic value that's still in materials to keep us from having to do any more natural resource extraction than we have to. When it comes to emissions, though, and thinking about greenhouse gas emissions reduction, a lot of that actually has to do with things we've already talked about, how the source of energy, the source of electricity and the goods production, co-location of processing sites, last mile delivery, close proximity and distribution, centralization of collection resources. So those are some categories we think about as we make investment decisions, but also collect investment level actually performance data on a quarterly basis.
Thank you, Allison. So we haven't touched yet on the topic of agriculture and land use and forestry as it relates to CO2. While in the US, those two are listed kind of at the bottom of the list of CO2 emissions, in Latam and countries like Brazil, they account for a majority of the impact on CO2. And as we know, tragically, fires have destroyed 15% of the Pantanal this month, and many have been affecting the Amazon, which is now edging from carbon sink to a carbon source. So, Julia, your investments play a critical role at balancing economic development as well as conservation and biodiversity. So, tell us a little bit how EcoEnterprises Fund tackles this issue and balances these different need groups.
So, as most of you may be aware, agriculture, forestry, and these nature-based sectors that we invest in are deeply woven into sort of the social fabric of Latin American societies. Most countries in the region still depend heavily on the natural resources, be it agricultural exports or other exports from mining, oil industries, etc. Unfortunately, over the past decades or even longer, I would say there's never been a great appreciation for environmental aspects in these areas. In the bigger industrial production, even like in agriculture, that hasn't been the case because it doesn't have a price tag attached to it, as we all know. And in the broad sort of smallholder segment, which still dominates agriculture across Latin America, it simply hasn't been a consideration because most farmers, most small, medium-sized producers, think they can't afford themselves the luxury to consider environmental aspects and just need to focus on plain production and making a living somehow. So what we really try to do with each and every investment that we make in the region is to find innovative and sustainable models for replication. And that is valid for all sectors, be it agroforestry systems or more traditional forestry, or large scale agricultural production or transformation into food and beverage products, etc. So we try to find these examples that show others in the sector that they can build a profitable business and still make a positive impact and have a lasting positive effect in the communities and in the regions where they operate. So we try to really meet businesses in their reality. That's also very important for us, that we remain flexible and sort of in the type of business models as we consider, because we also see that there are many ways to contribute to a more carbon neutral future, to healthier ecosystems, more resilient sort of environments. So we really consider all different angles. For example, here in Colombia, we've invested in a large scale organic citrus operation. And while the organic orchards already sort of provide a huge sort of benefit in terms of environmental health and ecosystem health, we're now working with the company to identify specific nature reserve areas to participate in reforestation efforts, sort of to take that positive impact that they're already having a little bit beyond what they were already intending to do. On the other hand, we work with a company that works in different countries in the region and only sources from smaller suppliers. So that work that we're, for example, carrying out with this Colombian company, they can sort of pull that, like push that off to have the smallholders do that work. But what they do is they send their agronomists and they work with those hundreds of small producers on better environmental practices, in enhanced soil health. They implement a monitoring system to ensure that there is no deforestation in the area, that the farmers are sort of aware of how they take good care of their land and how they could even on a small scale, but sort of that sums up over the hundreds and hundreds of people the company works with, reforest or implement more sustainable practices that actually contribute to carbon sequestration, because they see a value in it, because they see that their land becomes more productive, that they can get certification that they couldn't access before, and that the company then pays a premium for. In Brazil, because you mentioned the Amazon, we have a long-term investment in a company that we actually invested in under Fund 1 for the first time. That started out as basically a startup at that time and has now grown into a multi-million-dollar company exporting acai from Brazil to the States and selling food and beverage products, smoothies, etc. And they've really sort of started that acai trend, and now maybe hopefully most of you sort of have tried it in the States. It has become one of the more sort of standard superfoods in supermarket aisles. But they were really the first ones to bring it to the United States. And what they have achieved over the past 15 years is to create a whole economy in the middle of the Amazon, because all the suppliers are local peasant and indigenous communities that work along the Amazon River in the middle of the forest and that wild harvest the berries. When the company started working with them, there was little appreciation for the standing forest sort of behind their river in their houses, because it didn't have a value for them. And they would cut it down if it was more attractive to sell the wood, or they would sell land if companies would move in. And all these areas are extremely exposed to illegal mining, to logging activities, etc. So over the 15 years that the companies worked in the region, they have effectively put under active protection through these communities, like thousands and thousands of acres of pristine rainforest, without ever implementing a formal national park or a government sort of protection program or something. It's really just through the interest and the incentives that they've set for the local communities that they now proactively protect these forest areas, because they see a long-term benefit in that. So we really have a diverse portfolio, and we try to remain very open to really look at new models coming in. Actually, we're also working now more and more on issues like circular economy in the sectors where we work, bringing in these ideas that we see in funds like Allison's, to sort of inspire our companies even more, or even see where those concepts could maybe result in new business models in these areas that could create additional benefits. And that could be in agriculture, absorbing waste products and find a second use for them, or working sort of in related sectors. We're actually just now looking at a company that works with industrial waste, something that we haven't looked at in the past because it's sort of out of our nature and sort of rural community focus. But what we've seen across Latin America, a big problem is waste recycling, and landfills are filling up, are taking more space. So they're moving into like across the borders where we so far had sort of more like untouched landscapes. So it becomes sort of more pressing issues that now moves into these rural spaces. So we're now looking at different companies in the sector that also work more in the recycling or waste management systems, benefiting rural areas, however. So for us, it's really all about building examples and building sort of these lighthouses, sort of with the hopes that in 10, 20 years at the latest, sort of there will be no sector left in the areas where we work that can sort of with good conscience continue to pursue business activities that don't include an environmental angle in the activities, because hopefully there will be sort of an opposite example for all of these traditional sectors that we have today that still have sort of limited appreciation for the additional positive impact that they could be creating.
Thank you so much, Julia. So a lot of our attendees are investors interested kind of both on the impact side, but of course also on the risk and return involved in some of these strategies. In the past, some of these low carbon strategies were considered more high risk, low return. Some of them were being piloted, developed. Now there's not only amazing managers and investors on this call, but also a wealth of new products and new funds migrating into the space. So let's talk a little bit that, you know, we all agree that this has changed, but let's walk through that journey in your specific funds. Allison, let's start with you. Just this week, last week, you received a $30 million investment from Nestle into your private equity fund. You have a long list of diverse corporate investors who are investing not from necessarily CSR money, but from procurement, M&A budgets, supply chain budgets. So tell us a little bit about, you know, what is their drive to invest in these circular supply chains, and how is your investor pool perhaps diversifying as we now attract institutional and high net worth investors into this?
Yeah, so this is an unusual event for me in that you have some family office and high net worth individual or managers type investors on this call, because I spend most of my time talking with corporates about their supply chain innovation needs and how they can use investments in our funds to advance circular economy goals that they have. So for us, the bulk of our capital comes from large consumer packaged goods companies and retailers, PepsiCo, Coca-Cola, Danone, and Amazon, Unilever, Walmart, et cetera. And they're interested in some cases more in what we call a strategic return or an impact return than a financial return. And other times it's more pari passu, it's closer to wanting both. Our institutional and family office investors are exclusively in our market rate vehicles, and they're interested in an attractive return for that asset class, but taking a lens of resource efficiency and circularity and material recoverability to this portion of their asset allocation. The interest of the corporates predominantly, so yes, Nestle is the most recent kind of big ticket investor in our PE fund. But for the most part, what these corporates are interested in doing is working with somebody who can be their agent in actually building out the system they want to play in. So they want more recycled content. There's not enough, especially in the plastic space, there's not enough polyethylene or polypropylene or high density polyethylene in the recycled content markets available to them today. Many of our investors are some of the most progressive sustainability commitment setting groups in the world, and they've thrown out a 2025 or 2030 target date scenario for themselves, and the gap is still very huge. So they need investment in the system that exceeds their ability to drive product and innovation through simply via demand pull. So that's where we come in, is trying to find them solutions, connecting them to each other, connecting them to the big corporates, delivering whatever the return profile looks like of the specific fund. And you know, a success for us will look like we've actually built the entire supply chain, not just achieved a nice return for our investors.
Thank you. And I assume that's, I mean, they keep coming back to reinvest for new strategies, et cetera. So, you know, there's lots of potential there, correct?
Yeah, so the nine original corporates in the closed loop infrastructure fund, which we started in 2014, all re-upped for another 5 years in that fund. We announced that earlier this year. And the reason we've launched these venture vehicles since then, initially below market debt was what we started with. It was a pseudo philanthropic investment really aimed at building the system without overtaxing the economics of an already kind of fragile US recycling economic system. But as we've gotten smarter, we've identified venture, nice venture, you know, 30% plus IRR return opportunities and PE opportunities in the mid and high teens, where we can actually take ownership positions in these companies, which is what we're doing in our PE fund. And in the venture fund, it's early stage investing, so it's smaller stakes, but the drivers are now visible enough to investors outside of corporate America that they want access to that risk profile in their portfolios.
Great, thank you, Allison. Julia, since Fund 1, you've had development banks and institutional investors supporting you. However, as you mentioned earlier, you know, as your fund got bigger and you guys became a bit more market rate driven, you've now attracted not only repeat investments from your institutional investors, but new high net worth and you know, other crowding in new types of investors into your organization. So can you tell us a little bit about, you know, how that happened and why you think it's happening today?
So as I mentioned at the beginning, we started out very early when the impact investing concept, specifically in that sort of particular environmental niche we're in, was still really like in its baby shoes. So when we started Fund 1, we had $5 million in investable capital from basically 3 development finance institutions and I think 2 private investors. And at that time, I think when the fund was fully invested, they financed 23 early stage companies across Latin America in different sectors. And in one of their sort of review meetings, one of the lead investors said, well, 23 is a good number. I would say if 3 of them survive, that is a big success. And sort of the investment team looked at each other a little bit surprised, because obviously their expectation level was way beyond that. They said that would be a blunt failure if only 3 companies survived. And they closed the fund, exiting all of the investments. 21 companies actually survived and kept growing fast. The 22nd company closed down business just to open sort of with a similar concept again 1 year later in a different region with sort of an adjusted value chain. And really only one of those 23 original businesses effectively went out of business after the fund wound down. And I think all the early investors at that time were not only surprised by those results, but were also extremely pleased that they recovered all the money they had invested, that they made a return, and that the fund had actually built the tools and the capacity to document sort of the additional upside in social and environmental return that those companies had generated over the lifespan of the fund. So at that time, the fund really set out for the second fund with much higher sort of expectation levels. All original investors reinvested, upping their investment. And I guess at that time, it was also the second fund launched in 2010. So that was when really sustainable markets were already seeing a big attraction, much more interest also from the consumer side. So at that time, and also obviously with the feedback and the backing from the early investors, more investment, like financial institutions came in, more institutional investors. But the fund team really set out from the beginning saying that while obviously institutional monies would be important for the impact investing sector for quite some more time, the end goal really had to be to make this an investment strategy that was attractive for private investors as well. So also they were very clear from the beginning that the fund would continue to aim for market rate returns to really prove that this is an investment strategy that doesn't have to be concessionary. Obviously, there will always be companies that maybe won't live up to market rate returns, or projects that just need philanthropy money or in support. But our strategy and goal really is to highlight those examples that show that there is a big and growing sector of businesses that really, to not exaggerate, but sort of can do it all, or at least try to do it all to the best of their abilities, and really build these models sort of as an inspiration for others. Second fund closed with, as I said, a multiple of the initial capitalization. And I think when we started to raise Fund 3, we're still in the middle of the lifespan of the second fund, but already exiting first investments. And obviously that also helped a lot, that we could show we're not only a second fund, we've not only tested it once, but sort of we are exiting successfully the investments we made for a second time around, and we had a clear strategy of where we wanted to take the new fund. For us, it was extremely gratifying to see that in the third fund, we had more private investors, not only from the United States and Europe, where sort of the bulk of our investors are located, but also from Latin America itself, because that in the second fund for us was sort of a strange development, that we didn't find a single private investor who wanted to invest in a Latin American fund. Again, that was 2010, there was economic crisis. A lot of countries here locally had sort of a difficult political situation. So investors were really looking to get their monies out of the region. And now with many improvements across the region, but also sort of higher, I would say, sort of education amongst the new generation of local investors, there's much more dynamic locally to really invest in local economies, in the potential that these regions and countries really have, with a lot of young entrepreneurs, with a lot of sort of willingness to support these growing sectors. And that has helped us as a fund tremendously to also sort of broaden our investor base further.
Wonderful, thank you, Julia. David, you talked a little bit about return profiles at GSRP, et cetera, but tell us a little bit more. First of all, you have I believe, $6 to $7 billion fund. Your strategy, as you mentioned, is almost is very low risk, almost like a yield product. So tell us a little bit more how you perform versus utility industry and any other sort of trends that you think are relevant. And then Luis, maybe you can jump in and share how that compares to Latin America and other trends you're seeing in the energy space.
Space with the, can you hear me? Yes.
Yeah.
We compare our space with the traditional utility space. We will have, like a 200 basis points, north of the utility space. And the reason, there are pluses and minuses. There in the utility space, traditionally, there are players with very low cost of capital that they don't mind to play the, the kind of post-merchant. They feel that really bullish about what the prices are going to be 15, 20 years out. And they play that game, but mainly the yields, you could expect, just north of 5 for utility space, but you're deploying a lot of capital at once. Having 850, power plants at the end of the day, whether they are half a megawatt or whether they're 50 megawatts, at the end it's a power plant. And like I always said, is one power plant is, one nightmare, independently of the size of the project, right? So from the operation standpoint. So the reality is that you have to be really You have to have the processes, the tools, and everything to really manage a portfolio, a DG portfolio, the right way. I think that there has been a lot of people exiting the market, thinking that, hey, this solar, I can own this distributed generation assets and no problem. And the reality is that it's a complete different sector. And Luis, please chime in, from the DG to the utility. Utility, you have this is a true power plant in the sense that there are people on site. Your KPIs will be keeping the uptime of the plant as high as possible, and be able to shift if there's any need of curtailment or whatnot. Where you have the distributed generation, which is a financial investment. Basically, sometimes it is advantageous for you to let the inverter or the half of the plant down, because it will cost you more money to go and restart that plant in the middle of December, where the production is going to be minimum, right? So having those processes, having the resources that know how to manage this type of asset and doing it effectively, that is what part of the reason why you have the 200 basis points. Also, it's challenging deploying a lot of capital, quickly. Investors that they want to invest in clean energy, they want to invest in clean energy now. I want to know, how long is it going to take for you to deploy the capital? And please don't tell me that it's going to take you 5 years, because then, in 5 years, I'm not sure where I'm going to be in my portfolio. So they want something fast. Now, that's why utility is good. I mean, you buy a project and you can deploy $300, $400, $500 million in one project, where in a small DG plant, you may just be talking about, sub of $1 million. So aggregating what we have, $2 billion of equity and a total, kind of vehicle of $7 billion with tax equity and debt it is challenging to do it in this space. So definitely, I would say the message is that there is an uplift in returns, going from utility to distributed generation. But personally, I think that also is lower risk investment. And if you have the right vehicle that can deploy capital in a kind of timely manner, is definitely accretive to anybody's portfolio, right? So.
Thank you. Luis, do you want to add anything to that from your vision? And you're on mute, by the way.
Yeah, I concur with the risk and one thing is it's challenging is deploying the capital to that granularity that offers as well a good portfolio management capabilities, because you're basically having a different type of PPA risk that you can handle better than having just one central location with one specific area and deploying a lot of capital in that specific area. So I think that is also a very good thing about the DG portfolio of assets. We see in Latam higher rates of low double digits, and always the risk is the quality of the PPA. We also see that the technological risk has been reduced considerably, and we also see that the possibility to enhance those projects, adding microgrids and battery capacities and EV integration, is also an upside potential that not necessarily the centralized and utility scale projects has. So we see that as a very good portfolio scheme.
And just going a little further for both of you on the investment trends in EV infrastructure and adoption, are you seeing a bigger interest in investing in this space, with Tesla now being larger from a market share perspective than any other automaker, and a lot of more potentially profitable trends in the space? Can you talk a little bit about electrification and also how that will tie in back to energizing, providing energy to the grid in the future?
Well, yes. Talking about the EV adoption, this is a trend that it's growing rapidly. To give you a perspective, in 2012, there were almost no EV vehicles in the U.S. Right now, in 2020, we're talking about a 1.7 million vehicles already on the road. And by 2030, we're expecting that sales of EVs will represent at least 30% of new sales, and to 2040, 60%. So the ramp up is very, very important, and we see a lot of opportunities there. And with that comes the infrastructure, and the infrastructure to charge those EVs and to be able to integrate those EVs in the energy mix. I guess this adoption of EVs and the trend that we're seeing is basically because of three things. You know, the battery technology has reduced in price considerably. The same way that a solar happened, battery cost has gone down 87% since 2010. And that is a massive reduction. The simplification of EVs are also making that people are, it makes a lot of sense to get into an EV vehicle. And digitalization makes sense, is also happening very fast in these type of vehicles, becoming more computers than vehicles. So the infrastructure to charge those will permit in the long run that these EVs with their batteries, as I said at the beginning, become assets as well, and batteries that can fit back into the grid to stabilize the grid. And that's what we call the V2G opportunities in the coming future. So where we see that cars and vehicles will deploy and also take energy, and that is a very interesting circumstance in the coming future. The Tesla thing, they have seen this before other players, and not only they're taking a big chunk of the EV of the vehicle market, but Tesla is also a very important player on the battery sector, not only on the EV side, but also on the stationary side. So they're taking a big chunk of the energy pie, and I guess the valuations related to that it reflects that situation.
And David, do you also believe that vehicles will be a critical part of the grid in the future? And how do you at GSRP kind of view that? Are you going to also look as that as part of your distributed energy play long term?
So I think that the energy transformation, you know, in the years to come is going to be brutal. Just think of like right now it's hard to really develop big power plants, renewable power plants in the middle of California or anywhere. So the movement is more to distributed generation. That's gonna and on top of it, if you add EV, if you add all those different mix, that I completely agree with Luis that the growth is exponential in that market as well. We're going to see something that we don't know today. How is the grid going to behave and going to accept all these changes, massive changes into the grid? You may have better numbers, Luis, so please correct me if I'm wrong. Last time I read that if we electrify the entire transportation sector, we're going to have to triple the installed capacity in the U.S. How are we going to do this? Because that is another reality. The electrical vehicles are coming and are coming in a massive way. And to be honest with you, I think that we may even beat the expectations. Just today or the other day, I was reading that California by 2035, they're not going to allow any combustion car to be sold. And California is a big market. So we're, and probably other states are going to take the same approach. So how are we going to create the infrastructure to really understand those changes that we don't know today, right? I would say two things. EV charging stations are definitely going to be, important, but important not only from the main functionality of charging the vehicles, but also, from the balancing standpoint, right? I always, we've talked about this. I feel like we're all going to be generators and consumers of electrons, and we're going to do that through the car, right, at the EV stations. So that is very, very interesting to me. And how we're approaching the market is from the software side of it. We're paying close attention to companies and develop internally things that will allow us to be more intelligent, participants in the market by capturing all that data of the new energy transformation. So that is, a way that we would like to play in. But of course, we're very, we're in renewable energy. We definitely want to make sure that we're going to be here for the years to come. Renewable energy as a whole. So battery storage is a focus of us. But EV will be at some point. We don't have any investment vehicle that is looking to EV at this, today. But I'm sure that the firm will get into that because it's an exciting and a very promising sector.
Wonderful, thank you, David. So we are talking about impact, so it's important to talk about measurement. And while not everyone here considers them necessarily a truly impact-only firm, most of you have in some way or another been measuring impact across your investments or across your portfolio companies. So let's start with Julia or Allison. Do you, the question is, do you measure, briefly, without too much detail for today's call, is that an internal measurement system? Are you doing emissions and stakeholders? And if it's internal, if it's external, what systems are you using? Julia, want to go first? No, she's like, no.
So I didn't want to jump the gun. Yeah. So yes, we do measure. As I said before, for us, that has been sort of the philosophy from the get-go, that we need to be able to prove that we're not just investing in businesses that we believe are doing a good job, but that can actually document and demonstrate that they're doing a good job, and that they built on the basis that we see when we start an investment and really sort of scale up efforts and scale up results. When we started, there were no external tools. So EcoEnterprises Fund developed a proprietary metrics measurement tool that sort of in its nth version we continue to use today. Those of the participants on the call that have looked a little bit deeper into impact investing may be familiar with IRIS, which is sort of the most comprehensive measurement tool out there today. And basically when they started to work on IRIS, they reached out into the market to existing impact investors and said, well, could you share what you are using? Because we want to sort of consolidate best practices and come up with something that could serve to new players coming into the field. At that time, they also looked at our model, and I would say sort of our tool continues to be like a mini IRIS. And we used them in parallel for a while, but then IRIS has become so comprehensive and so complex, because it basically covers every industry in the world, every size of business in the world. So we decided to continue to work with sort of the lean version of it that really is tailored to our sectors and our sort of types of businesses. And then I think that the more important thing, even than just to capture the data and to document the data, is how we communicate the data. And there we've seen that a lot of time really less is more. We try to consolidate really 3 to 5 key metrics across our portfolios, and then maybe provide 1 or 2 additional ones for like a specific industry or a specific segment, because obviously in ecotourism, you will have a different angle than in agroforestry, and some just won't overlap. But we try to really condense it in our reports to make it palpable for our investors, not overwhelm them. But we do have sort of a much broader database. And if investors are interested in specific metrics, we sort of have a much richer database to provide those data to our investors as we go along.
Thank you. Allison?
Yep, so we publish all of our impact statistics annually, and we report them to our LPs quarterly. So I invite you to visit our website, closelooppartners.com. You can look at our 2019 impact report. We track 5 metrics for every fund: waste diverted by landfill, which is even further broken down by material type, greenhouse gas emissions, jobs created, municipal economic growth, and in certain circumstances we'll also report water intensity. We don't actually track that for all funds because not all investors are as interested in it. Borrowers or investees, if we've invested equity, report to us quarterly. We work with every company to come up with a baseline. We also have a slide where we define our impact methodology. So there's a BAU definition. There's a template we give to each company to try to make it easy and consistent. I won't say that we don't add impact metrics over time as we get smarter and our investors want more and more, because more data is becoming available. But we try to make it easy for them. And the other thing I'll mention is impact definition for emissions reductions is proxy. So I think it's important to, with something like waste diverted from landfill, if it's throughput of X tons of corrugated cardboard coming through a recycling facility, that's easier to kind of confidently measure. But I think we all need to understand, and we use the EPA's WARM model for our emissions forecasting based on industrial activities that are done in the projects we invest in or companies we invest in. But I think we all have to realize that life cycle analysis and the greenhouse gas emissions estimation component of it is based on proxy. And to do it really well, you need a very geographic specific understanding of what the alternative reality would be that becomes your baseline. So our reporting is only as good as these generally recognized, even greenhouse gas protocol, if EPA WARM is kind of insufficient for our needs in a certain case, it's only as good as the specificity of the data that's available for that project type and that geography.
Thank you. That's a great point. Luis and David, maybe I'll start with you, David. I know technically you're not an impact investor. However, lately we've discussed how both the firm, Goldman Sachs, and your clients are starting to inquire more specifically around certain impact metrics. So what's kind of where you see the future of your reporting as a fund?
Yeah, so we have having so many different power off-takers. It's hard to have just one size fit all type of approach. A lot of different corporates that have different goals. The most important thing for us is having the data. So we invested in a software company, dedicated to solar or renewable energy in general, and we're creating kind of like it's not a asset management platform. It's more of a business front-to-end platform where we have all the data and all the different metrics that you can possibly imagine. And our idea is to have a software where the clients can customize their kind of outputs and be able to report to their constituents and whatnot. But when we start thinking about how do we create a report that will serve everybody, it was just an impossible task. Having today 850 different customers, off-take customers, and once we're fully deployed, we're probably going to have like a couple thousands of them on the first fund. So it would not be it would be impossible to create something that fits everybody. But very important, data. Right now, we're in a world where we're stepping in without the data and not really understanding how everything is going to work and what we're doing from the impact standpoint. So having the data rather available so people can massage it and can kind of like tailor it to their needs is extremely important. So that's what we're focused on: having the data, right data, and be able to customize as needed.
Wonderful. And you, Luis, anything to add to that on your side? You're on mute. You're on mute, Luis.
Sorry about that. Yeah, the same thing. All of our off-takers are interested on measuring the impact that we're receiving from our investments. And we have created, especially an OBE Power, a platform, a technology platform that allows them to see the impact that they're getting from the displacement of gas emissions. And I see that data will have to be utilized to make sure that all of investors and have that information on hand. And I will see that is something of the essence in the coming future for everyone that is in this sector. Thank you.
Before we kind of close out with your vision for 2030 and what the world will look like when you do succeed at reducing emissions by 50 to 70% so that we can continue living comfortably on this planet, I would like to address one question. There's a couple questions in the audience, and since we're getting close to the end, let me just start with the first one. Paula was asking, and maybe this is, well, for whoever thinks they're best suited, is there an appetite for investing in carbon capture technology, given the high cost in making the existing technology scalable? Anyone want to take that?
David, you may be better positioned as a sort of sell-side person now to answer. So we don't really do CCNS investing in our firm, and we are kind of decidedly not waste energy. There's a lot of capital available to that, and we're still operating in a sector that's in desperate need of capital that's really just focused on recycling and circular economy investing and not stopping at an intermediate stage of a liquid or non-liquid fuel. For CCNS, you've hit the nail on the head. They tend to be very high CapEx projects with longer payback periods. Do I know of more than a dozen dedicated funds with CCNS strategies? Yes. The other thing I think that may or may not be known to this audience is there have been a couple of really major corporate investments this year that have committed to CCNS as a big part of their strategy, Microsoft and Amazon being notable firms that have committed more than $1 billion to climate strategy with the CCNS vertical. So there will be access to corporate balance sheet funding, absent like traditional public fiscal or financial incentives. But I'm not going to lie, the high CapEx and in some cases technology risk is probably a deterrent for a lot of traditional investors.
Yeah, I believe Bill Gates's Breakthrough Energy Fund and a few others are taking on some of that risk at scale as well. Any other questions from the audience before we close out with the 2030 vision from our amazing panelists? Feel free to chat them into the chat or submit a question directly. In the meantime, why don't we start with each of you and what you think the world will look like when we all succeed at what we're doing. Anyone want to start? If not, please. Yeah, David.
I would state some facts, I guess, that I see in 2030. I mean, most of the energy will be renewable. I have no doubts about that. Most of the vehicle cells will be electric. I have no doubts also about that. Distributed energy will represent the majority of the energy being used, transact, and deploy. The energy cloud, talking about what David was saying, was basically the interconnection of consumers, prosumers, smart grids, EV drivers, and smart cities that will have a transactive data-driven energy market. So it will be completely different from what we're seeing right now, and I'm sure very well in line to 2040, where I think it will go faster the transition into a clean energy, truly clean energy economy.
I personally agree with everything that you said, Luis. What is extremely rewarding to me and also gives me a lot of hope is that I have two kids, 11 and 9 years old, and the 11-year-old, his dream car is a Tesla. He cannot even comprehend how a car could have an engine, like a combustion engine. For him, is the coolest thing is to get into a Tesla and see the screen and see that everything that doesn't make a sound. And he's just like, if you ask him what is your goal in life, is to own a Tesla, right? So that is so powerful that our next generation that is coming behind us and is going to be there. They're going to make this transition even faster because they think in a much different way that most of our generation even thinks today, right? My kids, they are the ones that when they see something on the ground, they pick it up and they go to the trash and throw it, right? Because it's like, why, we have to do these things, right? Can we maybe recycle? And when we moved to Florida, that was one of the things that they pointed out to us. It was like, why don't we recycle the way we recycle in California where we were living there? So that to me is to accelerate this process. And I think that in no time we're going to see a world where the carbon emission is going to be minimal, if not zero.
Thank you. And yeah, I agree with the Gen Z. I think I asked a group of students that I'll be teaching, why they are so passionate about impact investing. They said, well, because you guys, the adults, have left us a world where climate change is a reality we have to fix. So now we have to fix it. So it's funny, they sort of just taking it on as their responsibility. Allison, how about you? Next.
A pan-economic international carbon price would go a long way. Absent that, a national carbon price, a lot of the negative externalities that we've all alluded to on this call have to do with, and it's not exclusive to climate change, but under pricing in social and environmental and kind of macroeconomic risk. So I'm, over the next 4 years, I don't know, over the next 10 years, I'm more optimistic about a carbon price. I think a lot's going to hinge on this US election that's coming up and willingness to engage internationally, but that would go a very long way. And I think success in the sector that I work in now, circular economy, would be that using that carbon price as a lever to actually reprice extraction of natural resources to drive reuse of material.
Wonderful. And actually, there's a question, maybe this is for you, Allison, I'm not sure. If food waste is diverted, how will on-site with on-site
anaerobic digestion, yeah.
Oh, anaerobic digestion.
That's a very specific question. I am not an expert in greenhouse gas mitigation estimation for on-site anaerobic digestion. So I don't actually know what to tell you. I would kind of refer you to Greenhouse Gas Protocol and WARM and see if that's available, but I'm not sure how one would estimate that.
Thank you, though. I know you guys do have some anaerobic digesters in your portfolio, though, so thanks. Julia.
Yeah. Well, I guess so my hope for 2030, of course, is that all of us here achieve what we are setting out to achieve over the next 10 years, that all the investors continue to have an interest in these type of strategies. And from a personal experience, that when 2030 I walk into an investment conference or a summit and I explain what we do, I don't get this big eyes and like the surprised faces and people telling me, wow, this is so interesting, like that's so exotic. Like I would hope that in 2030 I'm one of many walking into an investment conference sharing our investment approach, and nobody sort of looks at me as if I was telling something innovative or new, because I really do feel that we should aim for making this a standard, and I think every investment group over the past years has contributed a great deal to showing that this is an investment segment where we work with the same standards and the same rigor and the same sort of expectation levels in terms of how we manage our investments. What we do isn't philanthropy, no matter the rates of return that we look for, but I would say nobody in the field sees themselves as a pure philanthropist, or if we're not working, as an NGO or to make donations or to support NGO work. That's a sector with lots of merit and important work to be done. But I think the impact investment sector really has great potential to scale up way beyond where we are today, and so that hopefully in 2030, no matter whether we use a car, plug in our electronics at home, go to the supermarket and buy food, or purchase any other product, I hope everybody should have, as a consumer, the good feeling that the whole value chain behind that is one that we can support and sort of feel comfortable with as a responsible human being wanting to leave that planet not only to our kids but the grandkids and the ones after that.
Right, even 7 generations after is one of the dreams of impact investors. But thank you, Julia. Yeah, on that line, there's a question from Silvio from Logos Capital. Are you seeing more interest into impact investing as a panel? And particularly, is there any more interest in debt over equity? Perhaps that's a good question for Julia and Allison.
So to start, in Latin America specifically, I mean, we are a private equity fund, so our investors invest equity in our fund, but then our portfolio really is a mix of long-term tailored debt instruments and quasi-equity instruments or mezzanine instruments where we work with sort of repurchase guarantees, etc. Because simply the market doesn't have the sort of mature exit mechanisms for traditional equity as we, for example, have in the US. So our investors' preference usually in the deals that we structure is debt or mezzanine instruments rather than straight equity instruments.
I don't think I have enough of a view on the impact investing market at large to really comment on an informed basis. That's my caveat. But in the sector that we're working in private markets investing for circular economy, you are going to see slightly different preferences among different investor types. I think corporates generally prefer debt. It's lower risk, especially if it's secured and senior, where they don't care as much about generating a premium over an alternate use of debt capital. I think when you get into more institutional, like big institutional segments, we have a couple of large institutional investors in our funds. They really want to see a traditional or even alpha above traditional return that it's hard to get from senior secured lending. So then you're looking into mezzanine or equity. And then family offices and high net worth are a mix. I find that with that group, a lot of it is about alignment of value with the person first in the sector they're trying to influence within the alternatives component of their asset allocation strategy. And then you could think about asset class, but really a lot of it is a sectoral and kind of impact first conversation, and then asset class is secondary.
And maybe to answer the broader question, the Global Impact Investing Network reported an increase from 500 B dedicated to impact last year to $750 billion this year. So certainly we're seeing a big increase. I don't recall the allocation in debt to equity there, although I believe real assets was the fastest growing segment of impact. So for our renewables, et cetera, investors here. And yeah, the trend is definitely being pushed as well by the next generation who see beyond ESG. They want impact to be a priority, even beyond material risk mitigation. So definitely they're driving the conversation in the US and Latam. So thank you for the great questions. Any other last questions before we close? I see Afia, thanks for participating. I know you had asked a little bit about interest in the Caribbean. For those that focus on Latam, are you also seeing investments and interest? Actually, I think, Julia, you also do some Caribbean investments in the impact space in the Caribbean. Julia, do you do investments in Caribbean, or am I wrong about that?
I'm sorry, I didn't hear the question. I was actually thinking about our Caribbean pipeline.
Well, just your interest in that space.
So it's a region we always include in our screening, and honestly speaking, where we have invested little, because most of the companies that we find there or that we've come across have sort of portrayed less of a drive to really scale up operations. We're more focused on local markets, and given that the markets are relatively small, so we look more for really the expansion finance piece. But it's a region we would love to do more in, because also obviously from the environmental aspect, it's an interesting area and worthwhile area to invest in. For us, deal size has been the biggest challenge in the deals that we've seen.
Thank you, Julia. So I think we'll close here. I hope that we successfully inspired you to consider investing in low carbon strategies, that we dispelled some of the myths about the risks, and we gave you hope about the opportunity as well to build a sustainable future. So thank you to our guests, to our panelists, and really, really appreciate your time today. Have a wonderful evening.
Thank you. Thank you all.
Thank you. Bye.